Silver just did something it's not supposed to do. In markets built on patience, silver doesn't explode. It grinds, it hesitates, it waits, and yet, in a shockingly short window, it didn't inch higher. It vaulted from around $50 an ounce to $90, tearing through decades of resistance like it wasn't even there. That's the contradiction. The most ignored metal in the financial system suddenly moved like the system itself was under stress. And this isn't abstract. Silver sits inside your phone, your car, medical equipment, power grids, and the plumbing of global finance. When it reprices this violently, it's not just traders reacting, it's supply chains, governments, and institutions scrambling at the same time. On January 14th, 2026, the move stunned even people who have spent their careers waiting for a silver bull market. One industry executive called it mind-blowing and aggressive. Language like that is rare for a metal that's supposed to be predictable. But here's the part nobody is saying out loud. Prices don't move like this unless something underneath has already cracked. And once that crack appears, it never stays contained. What you're seeing didn't start with a single trade or a single headline. It started quietly, then all at once. The official story is simple. Silver broke out because demand increased and investors noticed. But that explanation only uses part of the picture, and that's intentional. Here's what actually happened. The market didn't just move higher. It lost balance. Supply thinned. Liquidity dried up. And when buyers showed up, there was nothing on the other side of the trade. That's how prices jump instead of climb. This isn't an isolated spike. It fits a larger pattern that's been forming for years. Strategic resources becoming political tools. Physical commodities separating from paper pricing. Markets discovering very suddenly that assumptions they relied on no longer hold. Notice what's missing from most coverage. There's very little discussion about who controls the flow of silver, where it's refined, or how quickly access can be restricted. That omission matters. So the real question isn't why did silver go up? The real question is this: what changed in the system that made $90 possible at all? Because once you answer that, the next move becomes easier to see. The claim sounds extreme, but the evidence is already on the table. This move wasn't driven by excitement, it was driven by absence. Silver didn't surge because everyone suddenly wanted more of it. It surged because when buyers went looking, the metal wasn't there, the sell side didn't step in, the order book thinned out, and once that happens, price stops behaving rationally. Look at the numbers. Silver didn't crawl from 50 to 60. It jumped from roughly $50 an ounce to 90. In a compressed stretch of time, that kind of velocity only appears when physical availability collapses. One mining executive described the move as aggressive and mind-blowing, not as a win, but as a shock. That distinction matters. Here's what that tells us. Industrial users weren't speculating, they were covering. When manufacturers, refiners, and large buyers rush in simultaneously, it means supply has already tightened behind the scenes. Now notice what wasn't denied. No one stepped forward to say inventories were comfortable. No one claimed supply chains were stable. No one promised relief was coming. That silence is loud, because when a market stops reassuring you, it's usually because it can't. And once scarcity becomes visible, price is only the first reaction. Now watch how fast this escalates. Once scarcity shows itself, the market stops behaving like a market and starts behaving like a reflex. What should be temporary becomes normalized. What should trigger intervention gets waved through as price discovery. And suddenly an extreme move is treated as the new baseline. We've seen this before, not with silver specifically, but with strategically important materials. Rare earths, energy, semiconductors. At first there's a disruption, then there's a justification, then there's a quiet acceptance that access is no longer guaranteed. Prices don't spike once, they reset higher and stay unstable. That's what's happening here. $90 isn't being treated as an anomaly. It's being absorbed, contracts are being rewritten, Buyers are adjusting assumptions. The idea that silver will simply drift back down is fading in real time. Here's why that's dangerous. When markets normalize stress, they stop preparing for relief. Volatility becomes the cost of doing business. And once that mindset takes hold, every additional shock compounds faster than the last. This is where the story flips. The rally stops being about price and starts being about control. And when control enters the equation, reversals don't come easily. The second layer of evidence is harder to ignore because it exposes a contradiction that can't be smoothed over. On one hand, the public messaging stays calm, markets are said to be functioning, supply chains are described as adjusting. On the other hand, actions tell a different story. Physical silver is becoming harder to access at the exact moment demand is accelerating. And when that happens, words stop mattering. Here's the detail that changes how you see this. China, one of the world's most important silver refiners, moved to restrict silver exports by requiring state approval. That single policy didn't just slow shipments, it introduced friction into the entire global system. Suddenly, silver mined in one country, refined in another, and sold elsewhere wasn't guaranteed to move freely anymore. That's the contradiction. Silver is priced as a global commodity, but it's now behaving like a controlled strategic asset. Notice what followed. Industrial buyers didn't wait. They rushed. The scramble to secure inventory intensified the shortage, which pushed prices even faster. The move from 50 to 90 wasn't gradual because it wasn't optional. It was defensive. This is the moment the illusion breaks. When access depends on permission, price no longer reflects value. It reflects urgency. And urgency doesn't negotiate. Now the pressure stacks, and it stacks fast. At the same moment, supply tightens. The world outside the market starts to destabilize. Political shocks, military escalation, regime risk, none of these arrive alone. They arrive in clusters. And when they do, markets don't analyze them one by one. They compress them into a single reaction: protect first, explain later. Capital starts moving defensively, not into growth stories, not into long-term bets, into things that don't rely on promises. Silver sits right in that path. It has no counterparty, no earnings call, no vote of confidence required, and the speed matters. This isn't a slow reallocation over months. This is buyers moving simultaneously, under pressure, with incomplete information. Every delay feels dangerous. Every hesitation feels costly. Here's what makes this unstable. None of these forces are resolving quickly. Supply constraints don't unwind overnight. Geopolitical risk doesn't disappear on schedule. And once capital shifts into protection mode, it doesn't snap back easily. Momentum builds on top of momentum. Stress feeds stress. So now the system is carrying multiple shocks at once. Now bring this closer to home, because this isn't happening in a vacuum. When silver moves like this, it doesn't stay contained inside charts or trading desks. It bleeds into everyday life. Higher silver prices mean higher costs for manufacturers. That flows into electronics, medical devices, energy infrastructure, and transportation. Not overnight, but inevitably. If you've noticed products quietly getting more expensive, repairs taking longer, or supply timelines stretching without explanation, this is part of the same pressure. Companies don't announce when input costs spike. They adjust behind the scenes. Smaller firms feel it first, then consumers do. And here's the uncomfortable part. This isn't about ideology. It's about friction. When a material that underpins modern technology becomes scarce or volatile, the system compensates by pushing stress outward, onto workers, onto prices, onto reliability. You don't need to own silver to be affected by this. You just need to live inside an economy that depends on it, which you do. This is how abstract market moves turn into real constraints. Quietly, gradually, then all at once. If this feels familiar, say so in the comments. Because what's happening here isn't unique, it's a pattern. And once you recognize the pattern, the next layer becomes harder to ignore. The reason this keeps happening isn't chaos, it's structure. Modern markets are built to look liquid right up until they aren't. Leverage stretches supply, paper claims multiply, efficiency trims buffers. Everything works perfectly as long as nothing goes wrong. But the moment a real-world constraint appears, the system has no slack. It snaps. Silver exposes that weakness because it sits at the intersection of finance, industry, and geopolitics. It's traded like a financial asset, consumed like a raw material, and controlled like a strategic resource. That combination creates a vulnerability most people never see until it's stressed. Here's the unsettling insight. The system doesn't reward resilience. It rewards speed and scale. That means concentration, refining hubs, centralized approvals, just-in-time delivery, all efficient, all fragile. So when a choke point tightens, power flows instantly to whoever controls access. Not because of conspiracy, but because of incentives. Control beats abundance, permission beats pricing. This is why reactions always feel late. By the time volatility is visible, the leverage has already done its work. The story isn't about silver misbehaving, it's about a system revealing what it was always optimized for. And once you see that, you start to wonder where the next pressure point is forming. From here, the path forward splits, and neither option is comfortable. One path assumes stabilization. Prices cool, supply slowly adjusts, volatility compresses. In this version, silver doesn't crash, but it stops accelerating. The system absorbs the shock, rewrites expectations, and moves on with a higher baseline. That's the optimistic trajectory. The other path assumes momentum wins. Supply restrictions linger. Demand stays defensive. And every attempt to pull price back triggers another scramble. In that scenario, 90 doesn't act like a ceiling. It acts like a floor. Each consolidation becomes a launch pad instead of a release valve. Here's the key uncertainty. Markets aren't waiting for clarity. They're moving ahead of it. Contracts are being written, strategies adjusted, and capital positioned based on what might happen next, not what's already confirmed. That's how inflection points work. Decisions get made before consensus forms. By the time the direction feels obvious, the move is already underway. So the question now isn't whether silver changed, it's whether the system around it can keep up, because the next move is already forming, whether anyone admits it or not. Here's the insight that ties all of this together. Silver didn't break the system, it revealed it. A market that depended on smooth flows, easy assumptions, and invisible buffers suddenly ran into a real constraint. And when that happened, price became the messenger. $90 isn't just a number, it's a signal that the old framework no longer applies, that materials once treated as interchangeable are becoming strategic again, that access matters more than efficiency, and that stability, when it exists, is often borrowed. This is why moments like this don't end cleanly. They evolve. Today it's silver. Tomorrow it could be something else just as foundational. The pattern doesn't announce itself in advance. It only becomes obvious in hindsight. That's the deeper story most coverage misses. Not the spike, but what it implies about the structure underneath. If you want to understand where this leads, you can't just watch prices. You have to watch pressure points. This isn't the end of the silver story. It's the beginning of the next chapter. Follow the channel if you want to stay ahead of what comes next.